Well, it's the largest pension fund in this country. With about $200 billion worth of assets, Calpers manages money that's bigger than the budget of California itself. But right before the financial crisis, the fund did take on some riskier bets on its portfolio, causing it to lose more than a third of its value when the market crashed. How is it positioning right now? Well, Joseph Deere is the Chief Investment Officer of Calpers. He joins us now live from Sacramento, California. Good morning to you, Mr. Deere. How are you positioning yourself right now?
We're positioned as we have been for the long term. We have a diversified portfolio of global assets managed internally and externally with some of the best managers in the world.
And does that mean more private equity investments, less hedge funds? What does this mean?
We did an asset allocation review after the crisis, and our board reiterated its position with respect to this diversified portfolio. It's about half global equity, 20% fixed income, 14% private equity, 10% real estate, 2% cash, and 5% for inflation-linked assets. It looked to some outside observers that when we moved the private equity allocation from 10 to 14%, that it was a big move. But actually, at the time, private equity represented about 13% of the portfolio. So it was really a recognition of where that allocation was going to grow to.
And what drove that? Because it did garner a lot of attention.
Well, it did. Look, if you're trying to make 7.75%, which is our funding target, I don't think you can do it if all you have in your portfolio is a U.S.-oriented stock and bond positions. That we think private equity over the long term will give us about a 3% increase above what we get in global equity markets. That's the edge that will help us achieve our return target.
Now, you are also putting some more attention these days on standards regarding management fees with private equity firms and the like. What's driving this right now? Why are you reviewing this?
We, along with a lot of other pension funds, are supporting a set of principles and best practices that the Institutional Limited Partners Association has put forward. If you look at the cost of managing a program like Calpers, the overwhelming majority of that expense is fees paid to private equity and real estate managers.
You paid $50 million over 5 years to a placement firm?
We didn't pay any of that. Now, the general partners pay placement agents, and that's a different subject, which I'd love to talk to you about. But with respect to dealing with the general partners, we want better alignment of the terms of our agreements with them, and we want to make sure these management fees are adequate to support the operations of the companies, but not a source of profit. And with other limited partners, we're going to have a dialogue with the industry about getting those things done.
Now, I was referencing the placement agent fees. Do you want to respond to that?
Sure. Well, we're doing a special review with outside counsel to look at all of the placement agent relationships that Calpers has. We want the facts to come out. We want to follow the facts wherever they lead them, and we're working with the authorities about this study. But I think it's really important to understand that the general partners are the ones who decide to engage placement agents, and they have to pay them out of their cost of operations. It does not come out of the pension funds. And one of the purposes of the special review is to make absolutely sure that is in fact the case, that no pension fund money is going to the payment of placement agents.
Now, it has also been reported that you're reviewing your relationship with Apollo Group. You've got $4 billion in commitments with Apollo right now. That's raised some eyebrows. There has been a long-standing relationship with Leon Black's Apollo Group. Can you explain that?
We are doing that. I started in March. We have $20 billion invested in private equity and another $22 billion of committed and uncalled capital. Apollo is our largest relationship. We're interested, as already discussed, in improving the fees and alignment that we have with our general partners, so it was logical to start with Apollo. I think it's important to understand that we've had a relationship with Apollo since 1994, and if you look at their track record, at their performance, it's been quite good.
Is that relationship, since it's being reviewed, in jeopardy right now?
The purpose of the discussion is to get better alignment of fees and conditions, of terms and conditions. Again, at the time the placement agent information came out, the performance data for Apollo was at March 31. If you looked at anybody's distressed debt portfolio at that time period, you would have seen some trouble. Since then, the credit markets have improved dramatically, and these funds are now performing at or above the capital we've committed to them, and their long-term outlook is good. Again, about performance, we're confident with Apollo's ability to perform.
Now, you're today posting jobs on your site for a COIO position. Why are you hiring, and what is this job going to be?
Well, this is a great job, and thanks for bringing that up, because I get a chance. Anybody who's listening wants to have some fun in the public sector. This is the operations of Calpers investment program. The back office, the middle office, involves a system to support our operations. Also involves policy coordination. It's the #2 job, the chief operating officer, and we're looking for a great person to join our team.
All right, thank you so much, Joseph Deere, Chief Investment Officer at pension giant Calpers.